Welcome to Iron Financial. We're here to help you forge a stronger portfolio by cutting through all the market weakness and noise. Today, we are putting Emerald Holding, ticker EEX, right under the microscope. And let me tell you, this company is sending some seriously mixed signals. Our job here is to figure out if they're building a fortress or if this whole thing is just a house of cards. All right, let's just get right to it. On the surface, Emerald Holding just dropped some numbers that honestly should look fantastic. For the full year, they reported a massive 16.2% jump in revenue. You know, in an economy like this one, that is a number that should have Wall Street popping champagne corks. Yeah, it should. But the exact opposite is happening. The stock is getting hammered. The market isn't buying this story, they're selling the stock, and hard. This is a classic textbook disconnect. It's like a flashing red light on your dashboard that tells you, hey, we gotta look under the hood, now. How can a company brag about a transformational year with that kind of top-line growth and then watch its stock just tank? The market is definitely seeing something it hates. The big question for us is this a deep structural flaw, a red flag for a total collapse, or is this just a classic case of a misunderstood opportunity? That's what we are here to find out. Okay, so to really get to the bottom of this, we've laid out our analysis just like a structural engineer's building inspection. First, we're going to dig into the conflicting signals that have the market so confused. Then, we'll break down exactly how they forged that top line and start looking for the cracks hiding just beneath the surface. After that, we'll take a hard look at management's official blueprint, gauge the real integrity of their 2026 structure, and then we'll wrap it all up with our final Iron Financial verdict. So, let's get to work. Right, so before we can even begin to assess the structural integrity of Emerald Holding, we absolutely have to understand the two powerful opposing forces that are pulling this stock in completely different directions. On one hand, you have a number telling you everything's fantastic, and on the other, you've got a number that's screaming the ship is taking on water. This right here, this is the very source of all the market's confusion. And this slide just lays out that conflict perfectly. I mean, just look at these two numbers side by side. Over on the left, a really solid revenue beat. They pulled in $132.7 million in Q4, which was more than the street expected. That's the headline they want you to see. That's the win. A win? But look at the right. It's an absolute catastrophe. The market was looking for a profit of 5 cents a share. Instead, the company comes out and posts a loss of 15 cents a share. Let's be really clear here. That is not just a miss. It is a 400% negative surprise. Just let that sink in for a second. A 400% miss is not a rounding error. It's not a minor oops. It means their own internal profitability projections were in a completely different galaxy from reality. So how in the world can management get on a call and celebrate revenue growth when they were that catastrophically wrong about their ability to turn any of it into actual profit? It immediately makes you question the quality of that growth. Is it just empty calories? You know, that is the perfect question. So, before we start stress testing this company's foundation, we have to examine the raw materials they're using to build this top line. Where is all this revenue actually coming from? Is it strong, organically forged steel, the kind that lasts? Or is it just cheap plasterboard that they've bolted on to make the whole structure look bigger and more impressive than it really is? Let's start with the big, full-year picture. For 2025, their total revenue clocked in at $463.4 million. Now, that represents a 16.2% increase over 2024. In this market environment, you have to admit that is a very respectable growth figure on its own. And what's really interesting here is that the growth actually picked up steam toward the end of the year. In the fourth quarter alone, revenue shot up 24.3% compared to the same period last year. So on paper, this isn't just growth, it's accelerating growth. This is the exact narrative management is hoping you focus on. But here is the thing, that growth didn't just appear out of thin air. It wasn't forged in their existing factories, so to speak. If you look at the company's own filings, it's crystal clear this growth was bolted on. They went on a major shopping spree in 2025, buying up several new businesses. The key drivers here were Generis, This Is Beyond, and Insurtech Insights. They literally went out and bought their revenue growth. And there it is. Okay, this is the classic buy versus build strategy. So is this real, sustainable, organic growth we're seeing, or are they just using a roll of cash and a series of acquisitions to paper over some serious weakness in their core business? Look, it's easy to make your numbers look great if you just keep buying other companies. The real question is, if you strip away all these shiny new toys they just bought, is the original structure, the core business, starting to rust out? Well, management has an answer for that exact point, and it's a really crucial piece of this puzzle. They've calculated what they're calling pro forma organic revenue growth. It's a bit of accounting gymnastics, but basically it means they went back and recalculated their 2024 numbers as if they had owned these new companies for that entire year, just so we can have an apples-to-apples comparison.
And based on that math, they are claiming that the underlying true organic growth is a solid 4.8%. Now, let's be honest, 4.8% is a lot less exciting than 16.2%, but it does suggest that the core business isn't falling off a cliff. It seems to be holding steady. But it also confirms that the vast majority of their big headline growth was in fact purchased.
Holding steady isn't good enough if the whole foundation is crumbling. A shiny new exterior doesn't mean a thing if the plumbing is shot and the wiring is frayed. That 400% EPS miss tells me there are some very deep problems here. I think it's time we stop admiring the new paint job and start stress testing these numbers to find the real cracks. Let's start with the most obvious, most glaring crack of them all, the one we just keep coming back to, a 400% negative surprise on earnings per share. This is not a hairline fracture, people. This is a chasm that just opened up in their profitability. It is the first and most damning piece of evidence that something is structurally wrong with the cost side of their business equation. So now let's look at what caused that chasm. Here it is, selling, general, and administrative expenses, what we call SG&A. This is essentially the cost of keeping the lights on. It's all the day-to-day operational spending like salaries, rent, and marketing. Well, for Emerald, their SG&A absolutely exploded. It ballooned by a staggering 156.4% year over year in the fourth quarter, hitting $88.7 million. Now, to put that into perspective for you, their total Q4 revenue was $132.7 million. That means that for every single dollar that came in the front door, nearly 67 cents went straight back out just to cover these operational costs. That is an absolutely unsustainable structure. It's a massive, massive bleed. And this slide right here, this is where the damage becomes completely undeniable. Free cash flow. We talk about this all the time because it's the lifeblood of a company. It's the actual cash it generates after all the expenses and investments are paid for. And for Emerald, it completely collapsed. In the fourth quarter, their free cash flow was down 45.1% from the year before. So think about that. The company is bigger, it's bringing in more revenue, but it is generating significantly less actual cash. That is a major, major red flag. So the crucial point is this. They bring in more money, their costs go through the roof, their profits completely evaporate, and their cash generation falls off a cliff. So this brings us to the fundamental question that management absolutely has to answer. Where did all the money go? You can't just brush off a 156% spike in expenses and hope nobody notices. What are they spending it on? Is this the real cost of integrating all these new companies? And if it is, what is management hiding from us about how difficult and how expensive this transformational year has truly been? You're absolutely right. We've got the conflicting numbers, and we've identified the major stress fractures. So now it is time to look at the official explanation. You know, every company has a story, a blueprint that they present to investors. We need to take a really close look at Emerald's blueprint to see if it's a solid, well-engineered plan for a real recovery, or if it's just a flimsy paper sketch designed to distract everyone from the real problems. And here is the official line, straight from the CEO, Hervé Sedki. He calls 2025 a transformational year. He talks about making the business more resilient and structurally stronger. This is the core narrative they're selling, a year of really heavy lifting and strategic investment that they promise will pay off down the road. They're trying to frame the pain that we see in these numbers as just a necessary cost of building a bigger, better company for the future. Of course they are. Structurally stronger? Are you kidding me? Their costs just went up 156%, and their free cash flow fell off a cliff. That quote is just standard issue corporate jargon that completely and conveniently sidesteps the real issue. It doesn't explain a single number. It's just a word salad designed to make you look at the beautiful architectural rendering instead of the cracked foundation that's right there in front of your face. We need explanations, not platitudes. Okay, let's get into those explanations then, because they are in there. You just have to dig for them in the financial reports. A huge chunk of that massive SG&A spike comes from something with a very fancy name, contingent consideration remeasurement adjustments. It's a mouthful, I know, but what it means is this. When Emerald bought those new companies, the deals included what are called earnouts. Basically, if the businesses they bought perform really well and hit certain targets, Emerald has to pay the former owners more money down the road. So this big charge to SG&A actually reflects that the businesses they bought are performing better than they originally expected, which is triggering these larger future payouts. So in a weird counterintuitive way, part of this massive cost is actually a sign of success in their acquisitions.
Okay, now let's deconstruct that awful free cash flow number because management has a very specific story here too. They argue that the reported number is totally misleading, and they point to two big items. First, there's a $30 million hit related to acquisition timing. Because of the way the deals were structured, cash that would normally have shown up in their operations was instead used to directly reduce the purchase price of the companies they bought. It's a subtle accounting nuance, but it has a huge impact. Second, they paid $6.5 million in one-time fees to refinance their debt. So you add those two things together, and you get $36.6 million in hits to their cash flow that management argues are not part of the core underlying business operations. Wait a minute, hold on. One-time costs? That is the oldest excuse in the book. Are they really one-time? They just spent an entire year buying of companies. The real heavy lifting of integrating these businesses, I'm talking about meshing technology platforms, combining sales teams, streamlining operations. That is not a one-time event. That's a multi-quarter, maybe even a multi-year process that is going to continue to bleed cash and create new, surprising one-time costs every single quarter. I am not convinced for a second that we've seen the end of this. And you just hit on the single most important question here. Is the pain in the past, or is there more to come? Now that we have management's blueprint laid out, it's time to look forward. We have to analyze their 2026 guidance to see if the structure they've built can actually handle the load they plan to put on it, or if these cracks are just going to get wider under the pressure.
And their guidance is certainly optimistic, I'll give them that. For 2026, management is projecting revenue to grow by about 6%. But what's more important is that they expect their adjusted EBITDA to grow even faster, at around 10%. Now, adjusted EBITDA, that's management's favorite metric for looking at core profitability. It strips out a bunch of stuff. This guidance strongly implies that they expect their profit margins to expand, which means they truly believe they can get all those crazy costs under control. But this, right here, this is the most crucial part of their entire comeback story. This is the one promise that underpins the entire bull case for this stock. Management is projecting that their free cash flow is going to completely rebound from that paltry $34 million we saw in 2025 to a massive $85 to $90 million in 2026. That's not just a recovery, that is a forecast for a very strong cash-gushing machine. Now, if they can actually hit this number, then their whole story about a painful but successful transformation will be true. But if they miss, the entire structure comes into question. And that is a huge, gigantic if. Hitting that number assumes that absolutely everything goes right. It assumes the integration of all these new companies is perfectly seamless from here on out. It assumes there are no more of those one-time surprises. It assumes they can digest everything they've bought while at the same time reining in the massive cost explosion we just saw. That is a forecast for perfect execution. And let me tell you, in the world of mergers and acquisitions, perfect execution is incredibly rare. The market is absolutely right to be skeptical of this number.
I agree with you 100%. The skepticism is completely warranted because the risks are very real and you cannot ignore them. We can boil them down to three key points. First, integration risk. The heavy lifting is not over, and any fumbles or missteps could put even more pressure on their margins. Second, cost control. They have to prove beyond a shadow of a doubt that the 156% SG&A spike was a one-time anomaly and not the new normal. They have to tame that beast. And finally, there's a huge wild card in the mix. The company announced back in December that it has received acquisition offers and is now conducting a strategic review. The entire company might get sold, which just creates this massive cloud of uncertainty that hangs over everything.
All right, we've examined the conflicting signals, we've inspected the revenue sources, we've identified the cracks, and we've scrutinized the blueprint. It is time to put all of the evidence together and deliver the final verdict. We need to determine the true structural integrity of Emerald Holding and decide once and for all if this is a solid foundation that you can build an investment on or if it's a dangerous trap for unsuspecting capital. Let's walk through the verdict step by step. First up, the foundation. The revenue growth is real, but let's be perfectly clear. It was purchased, not organically forged. That underlying 4.8% organic growth tells us the core isn't rotting, which is good news, but it's not exactly spectacular either. They've essentially laid a brand new foundation with all these acquisitions, and right now it remains completely untested. Second, the stress fractures. These are serious. The cost structure is without a doubt the primary concern. The exploding SG&A and the collapse in free cash flow, even with management's excuses and adjustments, show a company that is under immense strain. The heavy cost of this integration is a major crack in their armor. So what's the final call? This is not an outright trap. There is a plausible path to success here, but it is, without a doubt, a very high-risk construction project. The market's caution is completely justified. Emerald is firmly in what we call a show-me phase. The burden of proof is entirely on them. That is the perfect way to put it.
Right now, buying this stock is not a bet on the current structure. The current building is still covered in scaffolding, there are warning signs everywhere, and you can clearly see the cracks in the concrete. An investment today is a bet on the blueprint. It's a bet that management's 2026 guidance is not just a dream but achievable. You're betting on the architect's promise, not on the building as it stands today. And that leaves us with our final, crucial question. Is Emerald Holding truly forging a durable, cash-generating fortress that is going to reward patient investors? Or is this just a hastily assembled structure with a pretty facade and a completely hollow core? The numbers from the next 2 or 3 quarters are going to give us the answer. They won't just tell the story, they will be the ultimate stress test that proves once and for all whether this structure is built to last or if it's destined to crumble. We'll be watching very closely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.